All right, so WACC, the weighted average cost of capital. What we're looking at here is trying to understand how to use it and what we're going to use it for, and then how to compute it. We'll do the first two parts of those right now. So it's the average return investors expect to earn on the company. Different investors in the company, stockholders, bondholders, for example, they all have different risk and different cash flows, so they have different expectations on their returns. So this is the average of them. So a weighted average implies we're going to take an average of those that are invested in the firm. Now I've already reversed this. You can see this. It's the average return investors expect. And so we're basically going to equate what investors expect with what the company's costs are. It is the minimum return a company must earn to satisfy all of its investors. So if you have, say, two investors, one has $40 invested and one has $60 invested. If somebody has $40 invested and they require a 5% return, I need 5% of the $40 in order to satisfy them. But the $60, when somebody's got $6 invested, if they require 10%, then I need to be able to get 10% of that $60, which would be $6, 5% of the $40, looking at some smaller number, $2. So I need a total of $8 of the 100 in order to satisfy the investors. That's what we're looking for, is that I need to generate $8 out of the 100 in order to satisfy my investors. So it's going to be a weighted average of the investors that are involved. Failing to meet that standard, if I don't get $8, then I'm not going to have enough to generate all the cash flows that those investors are expected. It does not mean I'm defaulting on any obligations. It just means that I'm not generating all the cash that they were hoping to get or expecting to get. It's appropriate discount rate to use. This is the purpose of it. It's the appropriate discount rate for a project that replicates the exact risk of the company. So if you have a project that is a mirror image of your company, or just a small version of it, then the WACC would be the perfect rate of return to use for a discount rate for the cash flows for that project. And even if it's not, it can help you find the appropriate discount rate for any of the firm's projects just by trying to make a few adjustments. Okay, so let's look at that first part of that paragraph before with WACC. The cost of capital for a firm is roughly the rate of return that investors require. And it's going to have an adjustment. I'll make that here in a second, why it's roughly and not totally. So equity investors, common and preferred stockholders, these are equity. You have to pay attention to this when we do the math, that the equity investors are treated a little bit differently than debt investors, because the equity investors get paid dividends, or they get reimbursed by the stock price going up. All of those things are going to happen after net income, which is coming out after taxes. So equity investors get paid in post-tax dollars. There's no tax shield there. There's going to be one for debt. So the rate of return equity investors expect is exactly the cost of equity. It's dollar for dollar. Whatever they need, they're going to get has to come out of net income. Has to. Now, debt investors, the lenders and bondholders, they get paid interest, which comes before taxes. So if you're going to give some money to a bondholder, the only reason you do that is because you have to. It's going to come out in your earnings before tax, and so then you get taxed on a smaller amount. So some of the money that you give to your debt holders, you were going to be giving to the government anyway, and since you're going to lose it, you don't really care about it. So it's just the part that's the after-tax component that's going to matter. So the rate of return debt investors expect is actually going to be greater than your cost of debt, because some of that money is going to go away to taxes. If the tax rate is, say, 30%, then if you give debt investors $100 in interest, then 30 of those dollars would have gone to the government anyway. So the only part you care about is the $70. That's your only loss in that part. It works the same rate with interest rates. So if the tax rate is 30%, 1 minus the tax rate is the amount that the implication is going to be for your cost of debt. All right, so second part of that was the average return investors expect to earn. So it's the weighted average of the rates of return investors expect. So lenders, bondholders, these are debt instruments. Lenders expect the interest rate that is agreed to by the terms of the loan. They're not expecting anything extra because they don't get tipped. They don't get bonuses, at least not from you. Bondholders expect the yield to maturity. This is the rate of return they're expecting to get. Now, bonds are long-term. Typically, we're looking at long-term bonds. And if the bond has, say, 10 years to maturity, 3-4 years into the life of the bond, we might find that interest rates and the markets has changed. So the investors at that point would expect a different rate of return than perhaps what was initially done. So the coupon rate is never going to work for the rate of return the bondholders expect, because that coupon rate is, one, fixed at the beginning and things happen over the life of the bond. And then the second thing that happens is that perhaps the coupon rate was never meant to cover exactly the interest part. So the yield to maturity is the appropriate thing to use here, not the coupon rate. Preferred stockholders expect the dividends to be paid, and we typically value preferred stock as if it's going to last forever. That's where the word right there coming in. So we value preferred stock as if it is a perpetuity. Now, common stockholders expect dividends to grow at a constant rate forever. Hopefully that's only to make it nice. Remember, this constant rate forever means it's going to be growing like a growing perpetuity, so that we can value it. Or to get a premium for the systematic risk of the stock. Using the CAPM or the capital asset pricing model, we get what rate of return that those investors might expect in that case. So the weights are going to be market values of these instruments. They are not going to be the book values. The book values might be relatively close for some kind of debt instrument, but definitely not going to work for common stock. If you looked at the amount of common stock a company that's been 80 years old might have, it could be actually negative, because they'll have to purchase back shares of stock, or they have purchased back shares of stock over time, and they'll purchase them back at higher prices than the price that they sold them for, because the company's done well over this time. So these weights that we're going to use have to be market values. They have to be the dollar amounts. That's what we're going to be using for the weights. The other thing that you'll sometimes use is a target weight, that the company says that 80% of our company is going to be financed with debt. So then you could go ahead and use that number rather than what the market value numbers is based on that. All right, it's the minimum rate of return that's required. It's the rate of return that companies must generate in order to satisfy their investors. If a company earns less, investors are not going to receive a fair compensation for the risk they assumed. You're never going to hit it exactly right on, but when you hit less, they don't get everything that they were hoping to get. If you get more, then investors get that extra return, more than a fair compensation for the risk they take on. So if you have these investors, you do well, they get more than a fair compensation. If you do a little poorly, they get less than that fair compensation. This does not mean that you're going to be going out of business if you never hit this required rate. This just means that the investors that you have would be a little bit less than satisfied. As residual claimants, the common stockholders are going to bear the brunt of most of these extra returns. If you miss by $10,000, then that's probably $10,000 less that the common shareholders are going to be able to get. If you have, if you go over that and you make an extra $30,000 more than what you're expecting, that money is going to get shared for the common shareholders. They're the ones that get the excess returns. They're the residual claimants. You don't pay your bondholders, you don't pay your lenders, you don't pay preferred shareholders anything more than what you have to. So everything else goes to them. But you have to meet those obligations before you can give anything to common shareholders. So they are, as a residual claimant, going to get only what's left over, which would include some of what they're expecting to get and some, hopefully, extra. All right. The last part we're looking at is that a project's appropriate discount rate. One of the uses for a WACC is for capital budgeting. It's the discount rate we could use when looking at new projects. So the appropriate discount rate for projects is the rate of return that any investor should be expected to earn given the riskiness of the cash flow. It shouldn't matter if it's your company or any other company what the discount rate is. The discount rate should be completely dependent on the riskiness of the cash flows. But what is the riskiness of the cash flows, and what rate of return should you be able to get for that risk? There's two parts there. One, how risky are the cash flows, and two, what discount rate is appropriate for that risk. And it's going to be impractical to find that rate or estimate these risks. The easiest way, the only way we're going to get some kind of clean answers, is start using something like the WACC, the weighted average cost of capital, to use this for the opportunity cost of capital. It's the closest thing that we have that's going to make some kind of sense. If a project is similar to a different firm, then that company's WACC can be used for the opportunity cost of capital. Sometimes those companies are called pure plays. because they play only in that sandbox. They play purely in that sandbox, then they're a pure play. And so if you are a car company and you're looking at a tire project, then you might want to pick a tire company to use for its WACC for your opportunity cost of capital, since your own isn't going to be representing the risk of the project. So and in any case, the opportunity cost of capital can be adjusted if the project has less risk or more risk than what you've decided to use for coming from the WACC. So you can adjust it still if you think that it's not exactly what you're looking for. All right, I think this is going to bring us near the end on this. Here's a good idea of looking at how much corporations actually use these. So nearly all corporations and big financial advisors, I don't mean for individuals, I mean to major companies when they're doing mergers and acquisitions. Do they use the WACC? Yeah, they do. In fact, nearly all discount future cash flows that they expect the company to get by some discount rate. And nearly all of them use the WACC for this discount rate. About half the estimate use the WACC more frequently than annually. So you're asking, well, how often do you need to do this? A lot of them decide pretty frequently, more often than annually. And those that don't, generally annually, or you might do it every time that a major project comes up, they'll do it again. Or anytime there's some major adjustment to the stock price or something that would impact it. Most use the target or market values for the weights instead of book values. Book values don't work. It's some either combination of target or what we expect to happen or what we're trying to do or what we actually have at the time. And nearly all use the CAPM to estimate the cost of equity rather than trying to grow with the stocks. So then they need a market risk premium, and most use in the 5 to 7% range all the time. And most use about 10 years for treasuries for the risk-free rate. The reason they do it for longer terms is because you're looking at longer term investments, so they try and match it out. The last part about that then, where do they get the beta for the CAPM? That's the 3 parts. And they just look it up or they'll find out somebody else that's done this. So this is all the background on WACC. There's the equation, and we'll pick that up when we start doing the equation.